Get one more view then, and George Gero, Senior VP Financial Advisor at RBC Wealth Management, now joins us on a phone line from New York with his take on all of those commodities. George, hi, thank you so much for taking time out for us. Let's start with the base metals, which have really been mixed in 2014. Nickel is up 19%, while some other metals really seem to be closing 2014 on a negative. How do you see the prices going on from here?
Copper has been down somewhat, and on some of the base metals actually have done pretty well because we've had very good car sales, and while the economic recovery has been coming at a snail's pace, we look forward to much better recovery in the next few years.
George, so what's your view on the copper prices, especially with the weak data from China, recession in Japan? Do you see further pressure?
We've had slow recovery in China and slow recovery in Japan. Copper has come off their highs and has been trading at under $3. Going forward, we could, with a very good car year coming and better economic figures in the United States, see a recovery in copper next year, not this year.
Sure, George, your point is well taken. Let's talk about the precious metals then. And the gold prices have seen divergence in its movement in various currencies, in dollar terms, in euro, and in Japanese yen as well. We have seen gold prices gain quite a bit. How do you then read into that pattern?
Of course, there is a divergence of gold prices in various currencies. You've had a lot of geopolitical and political events that have affected gold this year. And in fact, gold has come off from a high of 1,900 to below 1,200, now trading close to 1,200. Funds have been fleeing gold because of their non-performance, because of a lack of inflation. And as crude oil has come off, that is also anti-inflationary, and all the European figures we have seen, such as the European PMI and other economic indicators, have been weak.
Well, yes, the funds clearly have been fleeing commodities and gold especially. But George, where do you see the gold prices taking support? What would be a good level to start buying?
Technically, on the short term, we have to see higher volume, higher open interest, closing prices of $12.25 to $12.50 in order to have a better technical picture for gold. And on the downside, if we break 1150, then we may see some further deterioration.
A final question, George, before we let you go. What stance do you see from the global central banks on gold? Because that, apart from physical buying coming in from Asian worlds, would be an important event to watch out.
Central banks traditionally do not like gold. To them, gold is a diversion. To them, gold is something that investors might prefer to debt securities that they issue. And in the case of Switzerland, recently we had a referendum that failed 70-30 for the central bank to purchase gold and store gold and add to gold holdings. While this was not a repudiation of gold, it was the conservative voter who decided that the central bank should have more flexibility to issue debt and pay dividends than to hold a non-paying asset such as gold.
All right, George Gero, we'll let you go at that. Really appreciate you joining us and sharing your opinion about all of those commodities in the global markets there.